Thierry да ви поговори за мнението на Schroders в момента за глобалната икономика, за това какво се случва в пазарите. Съвсем накратко, като преглед и след това има желанието да ви превърнем в разговор, дискусия, на която вие да си зададете вашите въпроси, свързани, разбира се, с чисто финансова тематика.
За политиката в България.
За чест.
I don't do Bulgarian politics, I'm afraid.
You're not an expert.
No. Oh, was that it? Was that the introduction?
Yes.
Oh, good. Thank you. Well, thank you everyone for coming. I don't know if you know anything about Schroders or myself. So my name is Thierry Clarke, and I'm the director responsible for Central and Eastern Europe and the Mediterranean for Schroders. A little bit about our company. We've been in existence for over 208 years, so one of the oldest and most well-established, I would imagine, asset management companies in the world. We manage roughly in euro terms around 260 billion euros worth of assets, and we manage equities, fixed income, commodities, property, etc. So a very, very broad range of strategies. And importantly, we actually manage money all across the globe. We have clients in 50 countries. We have offices, 37 now, sorry, offices across the world in 27 different countries. So we're a very global organisation, and we have investment people on the ground in many of those offices to really get close to the markets that we like to invest in, and to understand what we're doing, and to be able to provide some kind of knowledge advantage to us and to our clients. So that's a very kind of brief introduction. We do manage money for insurance companies, pension funds, central banks, as well as private individuals, through banks and through distributors such as Karoll. Basically we decided to work together. It was about a year ago, wasn't it?
Yeah, the decision was made in March last year.
There you go. So you've got the timings right. So yes, Karoll were looking for a partner with regards to offering international products to their client base. And we did a due diligence process, and thankfully Schroders was chosen as their preferred partner with regards to international funds. So we've had the funds registered here in Bulgaria since November, and been working on a number of bits and pieces since then. And this really is just an opportunity for us to discuss economics, markets, and where we see value in terms of investment. So they've asked me just to give a little bit of an overview in terms of economics and what have you, but I think it's worthwhile everything being interactive. So does anybody have any questions with regards to Schroders? Anything you'd like to know a little bit more about with regards to our history, our heritage, what we do, that you'd like me to elaborate on further? No? Everybody comfortable? Okay, good. I've brought a presentation. I wasn't planning on going through it kind of verbatim and going through it word for word, but there's some slides here that I may wish to kind of refer to. But generally, what I thought would be good in order to kind of set the scene is to talk about the economic backdrop and where we are at the moment with regards to the financial markets. And really the first thing to talk about, which everybody's been discussing for a number of years now, especially since 2008, is with regards to the debt that's in the system right now, and the process of deleveraging or bringing down that debt to a reasonable and sustainable level. And that's really one of the big topic at the moment, which will be around for, if not another decade. Probably the way that things are going, and is really having a major impact, not just in terms of economics, but in terms of politics and social dynamics as well. If we think about all of the riots and all of the austerity measures that are going through the world at the moment, the reason is because of the deleveraging and because of the amount of debt that governments, that private companies got themselves into. We had a lot of bank bailouts, and now the public sector has taken a lot of that debt on their balance sheet, and we're seeing the results of that. We're seeing a lot of changes in terms of the environment, in terms of the economic situation, in terms of policy, with regards to interest rates, for example, and in terms of regulation. And this is really the backdrop that we're kind of looking at in terms of investment right now. So there are a lot of things which we can talk about with regards to being a good idea and a good investment thesis, but one has to keep in mind the economic and the political and social implications of all of what's going on at the moment. And there are some kind of things to be aware of with regards to tail risks, what we call tail risks, so those events which we can't easily predict or foresee, and those normally centre around the political and social aspects. So everything I'm going to talk about tonight will be with a pinch of salt and having that kind of risk in the back of your mind as well that we need to be aware of. Just as an illustration in terms of the debt, slide 8 just gives you an idea of where we are at the moment. So at the moment we're looking at central bank debt roughly of around $7 trillion. It's a lot of money. And you'll see that that's been primarily accumulated by the US Federal Reserve and also the Chinese. The differences on the Chinese front is that they also have a lot of assets as well. They have about $3 trillion worth of assets which they're investing. So it's not such a big issue on their side, whereas the Federal Reserve in the US don't really have a huge amount of assets on their balance sheet. So they're the world's largest debtor. And they keep issuing money. And you've probably heard about quantitative easing or printing of money, and all of this cash which is being floated into the system and put into the system. And the big question mark that's been on everybody's lips is, well, what happens with all of this money which is being pumped into the system? Where does it go? What impact is it having? And shouldn't this really feed through into the real economy? Shouldn't we see it going into businesses, being lent to people that want to buy homes, for people that want to have, increase their infrastructure and their capital infrastructure of their businesses? And we're not seeing that. We haven't seen that kind of flow into the real economy. We haven't seen a huge pickup in terms of wages, nor have we've seen unemployment fall slightly, but it hasn't really fallen in the US especially too substantially. And the reason is that what's happened is the politics have also, and social dynamics have kind of got in the way of the money flowing into the system. And I'm going to ask you to look at slide 9. It's quite a complicated, well, it's not that complicated, but effectively what this shows is the velocity of money, i.e. the speed at which, if a dollar printed by the US Federal Reserve, how quickly does it get into the economy and what impact does it have? So, for example, they will put money into the banks will lend more to small, medium-sized businesses, those businesses will hire more people, they'll sell more things, and then you have this kind of virtuous circle of things hopefully working. Now, what you've found is the more money that's being printed, you'll see this sharp decline since 2007. The more money that's being printed, the less impact it's having on the economy. And one of the reasons for that is to do with regulations and to do with sentiment and negative sentiment with regards to the banking sector. So, for example, a lot of the regulations we've seen being put in place in the US and the Eurozone have been to do with capital adequacy ratios. So banks now have to hold more capital on their balance sheet in order to be able to lend. They have to make sure that the assets that they're holding, they hold cash against certain investment assets. So it's made it much more difficult for them to lend, to go out and lend money to small businesses, to lend money for mortgages, to lend money for credit card loans. And also they've had bad experience with what happened in 2008. And more importantly is the political pressure. I haven't seen the media here in Bulgaria, but everywhere else I go, you open up a newspaper and you'll see the media saying, look, these banks, they're really bad. They lend money to people that they shouldn't have done. They're really evil. And you've seen, a lot of senior bankers walking away from their jobs and resigning simply because they don't have the ability to make that business profitable anymore and do the same kind of things that they were doing before. Citibank, for example, we had Vikram Pandit leaving over a dispute with regards to remuneration and with regards to the direction of the business. In the UK at the moment, Royal Bank of Scotland, for example, which is 82% owned by the British government, they're now being told that they have to stop their international activities and focus less on investment banking, less on brokerage, and more on commercial and consumer banking in the UK. So all of this political action is changing the dynamics of the banking industry and stopping that money from flowing. So we're getting a lot of money which is being printed, but it's not really getting into the real economy. Consequently, what does that mean in terms of the way that we view markets, and what impact does that have? Is that we don't think that inflation is going to be a problem for a while. And we don't think that interest rates are also going to be on the rise for a while, because it's important that they keep interest rates low and inflation slightly higher than interest rates, so that you get a negative real yield on your money, i.e. you're losing the purchasing power of the dollar or the euro or the pound, because that effectively deflates or makes that debt that you owe in real terms less over the course of time. So this printing money situation is something that I think you'll see continually. It'll probably be less in less and less amounts because it's less and less effective, but we don't think that it's going to have that kind of massive impact in terms of inflation going into spiking up that people were concerned about. A return to the 1970s where we saw lots of kind of high inflation. It was much more recent in this part of the world. But we don't see that being a big problem. We don't see a massive inflation pickup happening in the near term. So that's kind of the backdrop. Does anyone have any kind of questions on that kind of stuff, on deleveraging, on inflation? No? Okay.
I just want
to
make one comment about the unemployment rate that you mentioned in the States.
Yeah.
Particularly because I don't know if you have seen the methodology that they are using right now. It's quite different than the one that has been used for let's say 2 or 5 years ago. So in fact the unemployment rate has now fallen. They are just calculating the unemployment rate based on a smaller amount.
Correct. I actually had a slide in here which I took out, but at the moment what they've done in the US is they look at something called the participation rate. So they calculate of the overall population, what percentage of the population are participating in the economy. So that will exclude pensioners, it will exclude people with disabilities, it will exclude people that, for example, don't want to work or that are doing other things. So, for example, mothers looking after children, etc. So it cuts and children as well. So it cuts out that portion of the population. And at the moment, they're calculating the figures, participation rate, as 62.5%. Now, historically, it's normally been at about 66.7%. And so that change in participation rate that they're using now basically underestimates the percentage of unemployment. So although they've statistically said that unemployment has dropped from 8% to 7.2 or 7.3, it's probably less than that. And the reality of the situation is that even with that current participation rate, and if you look at them, creating 200,000 jobs a month, which is what they're doing at the moment, it's still going to take them about 22 months to get to that 6.5% unemployment rate. So no time soon are we looking at interest rate rises in the US. If you take the participation rate at its kind of historical norm, you're looking more like 78 months.
And compared to that, you mentioned also the velocity of the money.
Yes.
It's directly affecting the GDP. So starting from the fact that the leveraging has started before the QE. So the banks are lending less money than they were doing 2, 5, 10 years ago, and the government tried to compensate and balance this. So the effect is a little bit slower in slower pace also because of this velocity and because of the regulation. So in fact, the problem is not whether this debt could be purchased back, or whether when the machine starts running again and interest rates go higher, if the government will be able to purchase the debt back on the same price. So because on 2 to 3 trillion debt, let's say, okay, 1.5 that has to be purchased in, let's say, 1 decade, they have to pay maybe twice higher rate than the one they were able to put into the market.
Yeah.
To compensate the leverage. But looking at the markets, without them being close to 14,000, the effect is there, so they are doing right at the moment, but what will happen in the future is not well.
Yeah, I think, well, you've made some very kind of astute comments there. I think the first thing to mention is you talked about the deleveraging starting. The fact is, let's separate the US from the Eurozone for now. If you just look at the US, the deleveraging has started and has gone a very long way in the corporate sector. And actually, if you look at the corporate sector, it's very healthy because business owners have been very wise in saying, hold on a second, we know we can't trust the government, we can't borrow money, so what we're going to do is hoard cash. So if you look at the cash as a percentage of GDP that corporates are holding in the US, it's at pretty much all-time highs. So the corporate sector has done a very good job, and they've done a very good job also through bond issuance. The way that they've got out of this is through issuing corporate bonds at very, very low yields, nominal yields. So and they've turned out their debt quite well. So the corporate sector in the US and also in the Eurozone is in pretty healthy shape, is in pretty good situation. What hasn't happened in the US is deleveraging has not started from the government perspective. And this is the big debate, the big political debate that's happening at the moment between the Republicans and the Democrats in the United States over how to tackle this deficit. How are they going to deal with this? Because there has not really been any austerity with regard in the US. The US hasn't pulled back on spending. The sequester which they had, which is the package of spending cuts which was implemented under the Bush regime, which was meant to come to an end at the end of last year, the so-called fiscal cliff, which everybody was talking about. That's just been kicked down the road to the 1st of to March, so it's pretty soon, and then probably be kicked down the road again. So you've got in the States you have this issue with regards to political deadlock, and you have the fact that the austerity measures haven't really come into place. So you're right in that down the road there's going to be a big problem there with the States. How are they going to pay back that money? Now, the way that they're getting out of it at the moment is that the dollar is the currency, the central banking currency of the world. So all central banks are buying dollars, and they're buying it at ridiculously low yields. And they're not buying it because it's making them a good return on investment. 2% return over 10 years, you guys are all business people, I'm pretty sure you wouldn't be happy with that for your business. So, it's not a good investment. But when I go and speak to central banks, and I speak to a fair amount of them, they have to because of regulation, because of liquidity requirements with regards to sterilisation of their currency. And at the moment, it's the only kind of safe asset that they're allowed to buy. So it's kind of an artificial situation. You wouldn't really want to be buying, again, you wouldn't want to be buying German bunds at negative yields. I mean, that's a crazy situation that you're paying the German government to hold your money for for 5 to 10 years. That's a crazy situation. But it's the dynamics of central banks at the moment. However, that will change one day, and there will come a point where people will not want to buy government bonds at those kind of low yields, and they'll go searching, and then there'll be a liquidity issue, I think in the US. So I'd be very cautious about holding government bonds in the US. I would not be having a huge amount of US government bonds in my portfolio. having exposure to interest rates is not a bad idea. So, you know, I don't think interest rates are going to raise in the US or the Eurozone for another 2 to 3 years. I can't see it happening. Because the one thing that Bernanke especially, and people in the Fed that follow his methodology, what he doesn't want to do is kill off any kind of recovery. And so he'll want to make sure that recovery is well underway and it's not going to have a massive impact. And I think any rate rise at the moment will cause panic with regards to the bond market. So I just don't see that happening anytime soon. And Ben Bernanke, he was a student of the Great Depression. And that's, if you've ever read any snippets from his thesis, one of his criticisms of central bank policy at the time was that they acted too quickly and they raised rates too quickly. And, you know, as I said before, inflation, a little bit of inflation, not runaway inflation, but inflation, 4% maybe, 4.5% inflation would be perfect. The government would love 4.5% inflation because that kind of inflation would, you know, I don't have the slides with me, but if we've done the calculations to see what the real cost of that would be, and it really does help you deflate that that pot of money that you have to give away. What the US really wants right now is a weaker dollar. They'd love to have a weaker dollar, and they just can't seem to catch a break as far as that's concerned, because again they keep printing and people keep buying, and it's the safety asset of choice. So people aren't chasing returns so much as thinking about safety. I don't think it's such a safe trade, but, you know, people are still buying the dollar. I don't know why the euros is where it is at the moment either, to be perfectly honest with you. That's another strange phenomenon.
And it's too high or too low?
I think it's too high.
Too high?
Yeah. The euro relative to the dollar.
And what will the states do if the rates fall? I mean, if euro dollar falls below 120, their debt, the deficit will rise in the next quarter of the year.
Yeah, but the thing is that the point from them is that GDP would pick up. That's their hope, because they want to create more of a manufacturing base in the States. If you listen to everything that Obama's been saying and all of their plans, it's to push manufacturing, and they want to be more competitive in relation to places like China, where you've got the opposite pressure of wage rises, wage increases, and you're actually seeing a lot of companies moving manufacturing, basic manufacturing. If you look at Nike, for example, they've moved manufacturing, a lot of manufacturing from China to Vietnam, to Thailand, to those kind of ASEAN countries where wage rates are much lower. And actually now you're even getting, you know, Mexico is becoming quite an interesting place. So you're seeing a lot of businesses opening up in Mexico. So I think you've got some interesting kind of dynamics there. And currency, I think, is a big topic. I think it's going to be something we're going to be talking a lot about. Currency, we're entering into a period where I think competitive devaluation, even though the G7 came out and said we will not be targeting currencies, I think they will. I think it's quite clear. You've seen the Swiss National Bank do it already. They've stopped the rise of the franc by unlimited, you know, buying of the euro.
So just verbal.
Sorry?
Just verbal.
Yeah. Yeah. I think the reality of the situation is that, you know, even if you look at the policy of the Bank of Japan, everyone was pointing at them because the yen devalued quite so strongly. I think what's going to happen now is that they're still going to pursue the same policies. They just won't say we're targeting currency. But yeah, I mean, in Asia, there's going to be a lot of. There's already. If I speak to my Asian colleagues, and I have a colleague who covers central banks globally, and speak to them about what they're hearing from the central banks in Asia, they're not happy having a strong, you know, a strengthening currency, because it severely impacts their exporting capability, and that's something that they're very, very, you know, precious about. And so I think you're going to find a lot of political tensions with regards to currency over the course of time. The Eurozone, I think, well, it keeps kind of changing from being okay to being not so much okay to being, I think, you know, this situation of politically led or political issues is not going to end itself anywhere near soon. We had the vice chairman of the bank of the ECB, Jürgen Stark, who was talking at our conference a few weeks ago. And I had the pleasure of sitting on the same table as him, and we were having kind of in-depth conversations about all sorts of things. But you know, one of the things that he was basically, he's always said, and if you read kind of his books or anything else, is that the Euro project is all about politics, and it's all about political will. And the current structure of the treaties, etc., don't provide for a lot of things that are being done at the moment, and it's literally all about the political will of everybody wanting to stay together. And as long as that cohesion continues, then I think the Eurozone will be okay, and they'll find a way of kind of muddling through from a political perspective. Now that's proving somewhat tricky because the mantra in the Eurozone has been somewhat different to the US. It's been all about austerity. It's been all about cutting budget deficits, about reducing debt, etc., etc. And that's a situation which is sensible on the one hand, but it's not necessarily pro-growth. And that causes some real issues, some socio-political issues, because we have a real tricky situation now. The fact of the matter is that the baby boomers who were born after the war have had a pretty good time in terms of free credit, lots of leverage, etc. But now that has to be paid back, and there's going to be a period, and it's not going to be a short period. It's not going to be 2 years. It's not going to be 5 years. It's going to be 10 to 15 years of payback, you know, and therefore this period of adjustment is going to be quite tricky. And the realisation that we can't continue the way we have done for the past 20, 30 years is going to be a really tricky one to get across. And so you're going to see political tension. You saw it most acutely in Greece. I mean, if anybody's, I've been tear gassed in Greece 3 times already in the past 5 years. But you know, their reaction to it has always been quite extreme. You know, get out, start rioting every Friday normally in front of Syntagma Square, and you know, it's got to a point where, you know, my colleagues that cover Greece, you know, she says it's very, very tricky out there because the whole political situation, socio-economic situation, has broken down because of the economics of what's going on. And you know, the question is it worth staying in the Eurozone? Is it really worth doing? People still think it is, but you know, now the Eurozone has had to be a little bit more friendly towards Greece because the political tension is so much that it threatens to break. And I think you see the same. You're starting to see the same thing in Spain, Italy. You know, I don't think it will get to that stage in Italy, because the Italians will just kind of get to the point where they can't be bothered and they'll just go and leave. But no, I think, you know, you've got that political issues across the whole of Europe where there's so little consensus about austerity versus growth. You know, the Italian elections, let's talk about something that's topical. The Italian elections shows you exactly that. You've got probably one of the best candidates there, Mario Monti, which came in 4th place. And he's talking about he's probably the most sensible out of all of the candidates, but the problem is he's not appealing to the masses. And you've got this massive, division between the disenfranchised kind of poor who feel that they're not being heard, and that, you know, then there's no future for them, there's no jobs. And especially the people between the ages of 20 and 40 that haven't, you know, that are unemployed at the moment. Those, you know, you've got a danger of this kind of lost generation of people, and how you deal with that from a social perspective. as well as from the economics of getting GDP growth started again. So it's quite a tricky situation in terms of Europe. I think, generally speaking, though, I think that there is the will to continue. The alternative is far worse than the current situation. But I just don't think it's going to be something that's going to be solved overnight. And I get the impression from markets that actually they kind of realise that. And so I think there is a consensus that yes, the Eurozone will continue. We're not thinking that, okay, a breakup is around the corner like we were before, so okay, let's just kind of get along and do business. The bond market's slightly different because government bonds and people in the bond market are using bond yields as a whip to make sure that governments do what they need to do. So, for example, Italian elections, things didn't go so well. What did you see? Bond yields start to rise, which means that the Italian government now, it's going to cost them more to pay back their money. So that's a problem. So it's kind of get your act together. When we start to see you on the right path, then all of a sudden we'll buy back into you, and your bond yields will lower. We've seen that in Spain. So if you look at what's happened with the Spain situation, although it's painful, the government's kind of stayed true to its course, and they have a much stronger mandate to be able to carry on. And you've seen bond yields fall and things kind of get a little bit more stable from an economic situation, not necessarily from a political or social situation. However, that being said, the corporate side of things is looking still pretty healthy. I think Europe to me actually looks like the best opportunity in the world from a corporate perspective. Because what people seem to forget is just because a company is listed or headquartered in the Eurozone doesn't mean that it's just looking at European growth or European GDP or European customers. A lot of these companies are global. And if you think of, and it's very different in dynamics to the US. The US is such a large market, 300 million people. You don't need to necessarily go international, and a lot of the companies there are fairly domestic. If you look at the geography and the structure of Europe, it's by its very nature, in order to expand, people go to different markets and they have that experience. And so European companies aren't scared of going to Asia, aren't scared of going to Africa or wherever there is an opportunity. And so you've got some really, really great businesses in the Eurozone doing very, very well that are purely discounted because they're listed in Europe. Not necessarily because they come, that's where they're making all of the large majority of their revenues. I mean, if you look at the index, the MSCI World Europe Index, there was a study done by Morgan Stanley, who run the indices, because they were looking to put together different types of index that get exposure to where businesses are making money rather than where they're listed. So looking at and they looked at MSCI Europe, and basically 48% of the revenues from companies listed in MSCI Europe comes from outside of Europe. So that's not an insignificant percentage. So I think there are some great opportunities in Europe, and the corporate sector's done pretty well, and has insulated itself in many respects from some of the banking crisis, some of the issues that are going on. And again, even in the financial sector, you've got some very good, sound banking institutions in the Eurozone and in Europe, which I think will be winners from what's happening in the markets at the moment. And we're seeing some good signs of recovery actually. Just for instance, on slide 12, you'll see this is the dots basically that you see are surveys which are conducted from purchasing managers, so people that do all of the kind of buying of stock and inventory. Economists use these as leading indicators to see where they think GDP growth will go. And as you can see, it's quite a good predictor. So the blue line is actual GDP growth, the dots show the trend. And the trend is showing that actually, although we're not talking about moving into positive growth in the Eurozone, we're looking at, you know, the recession bottoming out and us getting back to kind of some degree of stabilisation. And I think that's kind of fairly sensible and intuitive. And we're seeing some kind of signs of growth and some signs of things to be positive about in the Eurozone. So I think, you know, one thing that's we spend a lot of time talking about economics. And economics are, of course, important. But if you're buying an equity or you're buying a corporate bond, you're not buying just the economics, you're buying the corporates. And I think in this particular situation, the world that we're in at the moment, one has to slightly separate the two things. Yes, of course, macro environment, economics does have an impact with regards to the corporate environment, but it really isn't the be all and end all. And I think when you're looking for investment opportunities, it's actually looking through that's going to give you some really, really interesting opportunities. So that's really all I wanted to kind of talk about. That was the kind of gist of what I was going to talk about in terms of macro. You can probably tell from what I've said that I'm fairly bullish on Europe. The other thing that I'm fairly bullish on is equities. As I said, I think the corporate sector is very healthy at the moment, and more importantly, valuations on equity markets look very good at the moment. We've seen, slide 18 shows you the price earnings ratio of the market, and this basically is a valuation measure. And what this is telling us is basically if you look at trailing price earnings, so that's looking at trailing earnings, so the last 5 years' earnings over current price. If you look at projections of forward and future earnings over current price, or trend adjusted, so looking at the cyclically adjusted revenues over 10 years, then over each measure you can still see that actually the markets at the moment in general, and this is looking at the world markets, look fairly cheap. So what this would tell me is actually it's a good time to buy equities in general, which sounds counterintuitive because we've just been talking about all the risks with regards to macro environment. A lot of people are scared about going into the equity market, but actually now's the right time, I think. Well, a month and a half ago or 2 months ago was the right time, but it's still the right time now to think about buying equities. Slide 19 is worthwhile having a look at, and this basically kind of tells you which equity market I think is worthwhile having a look at from a valuation perspective, and that's the blue line, which is Europe. Europe is severely discounted relative to both Asia, relative to the United States as well. And as I mentioned before, there are some really, really interesting, really, really good quality businesses in the Eurozone that offer some great potential. And I think that right now Europe is a great bet for your portfolio. And as an indication of that, slide 20 basically shows you that what this is basically trying to say is the chart, the column chart on the right-hand side basically shows the average return that you would expect to make in 12 months when P ratios are within a particular range. So within a 10 to 15 times range or a 15 to 20 times range, 20 to 25. What this is basically saying, and this is no guarantee, I'm not saying this will happen, but statistically, you know, given where we are at the moment, you could expect a fairly healthy return in and around the 20% region from European equities right now because of where they're trading at. No guarantees. Don't quote me on that. But no, I believe it, and I've got it in my I've got European equities in my portfolio. I bought just before the end of I bought in November last year, and I'm very happy with that choice. So yeah, I think in terms of my top recommendation for you right now, European equities would be my top recommendation. I think European equities will do well. Bonds not looking so great at the moment. You've seen bond yields fall, cash rates fall. If I'm not mistaken, cash rates here in Bulgaria have fallen quite significantly, haven't they?
Right.
What are we at now? I've
Well,
lost
for
track.
a 3-month bank deposit, definitely below 4%. So, 3.4%.
In that.
So, which is pretty much half of what it used to be a year.
Okay. Well, yeah, I don't see that trend kind of changing anytime soon. Unless the banks, unless the banks need money, that is.
No.
Do you-
The situation here is so changing from hour to hour, so what
You never know tomorrow.
Well, I mean, if you think about the way that banks make money, so they will give you an interest rate, and then they'll lend money at a higher rate. Okay, and they make money traditionally on the net interest margin, the differential between the money that they're giving interest on and the money they're lending on. If you have a situation where they, for example, we saw this, I cover Russia as well, and we saw a situation where they increased the capital requirements, and also in the Baltics as well. I saw this quite evident. The Baltics was the best example, actually. So in 2009, they increased the reserve requirements that each bank had to hold. And so on a quarterly basis, what you tend, when they had to report on their balance sheet to the central bank, they were holding auctions for bonds and for deposits, and they were trying to attract deposits in local currency, whereas everybody wanted to hold euros because they thought that the currency was going, there's a peg, so that it was going to devalue. And so at one point in time you could get 30% on deposit, which was nice.
We've been there. It's
You've
not
been there,
nice.
you've been there,
Yes,
you've
it's
been
not
there,
nice,
you've
no.
been there, you've been there. But you know, normally there's a kind of political or some kind of reason for that, and so you've got to, you know, if you're doing that, you're taking risk. You have to be taking risk because, you know, no bank will pay you 30% interest without, you know, there being some reason for it. Okay, banks are not in the habit of giving away free money. So you know, there is some risk. But if you know, again, if I look at Russia now and you look at the deposit rates between some of the local banks and some of the larger international banks that are giving you know, deposits on rubles, there's a big difference between the two. So you know you're taking certain currency, you're taking certain credit risk by having your money deposit. But yeah, bond yields and cash rates, I don't think you're going to see startling rises in yields or cash rates at the moment, with the exception, I think the high yield market, the global high yield market looks pretty good right now. For the simple reason, as I said before, corporate sector is looking quite good, lots of cash on their balance sheet, default rates are really low at the moment, they're about 3.2%, which is pretty low. And so actually you're getting a reasonable yield, somewhere in the region of around kind of 5 to 7% on high yield bonds, and that's looking quite reasonable. But investment grade credit, not so great in terms of returns. Again, cash deposits, government bonds, mortgage-backed securities, all of those kind of things, not looking particularly attractive right now. So, no surprise then that in terms of fixed income, my main recommendation would either be high yield, global high yield bonds, or if you do want something a little bit lower risk, don't go government, go corporate, so buy an investment grade corporate bond fund. The other thing with regards to that is, if you're looking for some kind of bond-like return but with an equity and exposure to the equity market, convertible bonds offer quite a good and interesting scenario as far as that's concerned. They're a little bit more complex to kind of get your head around, but they're an interesting addition to your portfolio. But my main recommendation and the two things that I would urge you to have a look at, first thing is European equities. I think, you know, European equities are undervalued. There's a great valuation argument there. You can pick up some very good companies. And also, you can use equities to give you income and give you yield. And this is a concept which is very, very common in, for example, the UK, but it's very uncommon in Europe, in the rest of Europe. We, in the UK, have had, you know, dividend yield funds for a long time, and it's considered one of the staple ways of making an income and getting some kind of you know, regular yield. Whereas generally speaking, in continental Europe, people use bonds or cash for that. We have a particular equity yield, two equity yield funds that have an enhanced dividend that pays an 8% coupon, and that's something which I'm very keen on to talk to with clients. It's slightly lower volatility, slightly lower risk than investing just in the plain equity markets, and it provides a 2% coupon every quarter. So for those people that do want some kind of regular income, it's a really, really nice strategy. And then apart from that, the other thing that I'm talking to clients about is Asia. If you're looking for global growth, it's not going to come from the States, it's not going to come from the Eurozone, it's going to come from Asia. So if you want to buy into that global growth story, then Asia's a good one. So those are my kind of recommendations. Happy to talk about anything. If you've got any particular investments that you want me to comment on, or any sector or anything, more than happy to comment. So I'll leave it to you guys. Any questions? Or is everyone just hungry? No? Well, thank you very much for listening. Obviously I'm around, so we can continue our conversation over a glass of wine and some food. Was that okay? Thank you.